and welcome to our special series all about options. The much-awaited guidelines for the commodity options were released by SEBI in the month of June this year. And this was after the finance minister had announced in the budget for more derivative products in the commodity space. Since then, the exchanges, of course, have been preparing themselves on this. MCX, of course, is launching options in the gold by the month of October, that is. The instrument, of course, has picked up a lot of interest with the investors, hedgers, producers, jewelers, and, of course, common people as well. Well, we are joined by now a special panel on the studios to talk more about the same and give us, of course, a perspective on how you could trade it too. Joining us right now is Sanjeev Agarwal, who is CEO, Gitanjali Group. Gautam Choksi is ED, Hindustan Platinum. We also have with us Ashish Pethe, who's Director, Vaman Hari Pethe. And also joining us is Shivanshu Mehta, who's Head Bullion, MCX. Gentlemen, hi. Thank you so much for joining us today here. And let's start with you, first of all, Shivanshu. MCX is coming out with gold as the first commodity for options. First of all, what led you to choose gold as the first commodity?
So, Manisha, as you would be aware, MCX already has a leadership position in the bullion contracts. And within that, we have tried to serve the industry with a domestic price benchmark that our gold contract has actually become. It is unique in the sense that it has an active participation of hedgers, unlike no other contract as such. It has a diversified participation from the financial intermediaries equally. And the very linkage to the physical industry is the first point which comes to mind. And subsequently, of course, other eligible contracts would also be subject to regulatory nod.
Well, absolutely. Sanjeev, coming to you, a new product on the block. How excited are you to start trading on that?
Looking forward to it because it gives us a lot of opportunities to be more innovative, to come out with some interesting offerings for the customers. So lots of products and opportunities possible. The Indian jewelry market has evolved and over the last decade, it has moved away from family-run to more organized players. A decade back, the regional and national retailers was less than about 10%. Today is almost 30%. So as that market evolves, they have to be equipped with the right instruments or financial instruments available to be able to better manage their risks. And that's when an options is a very good product on offer because it offers the opportunity to get an upside and hedge your risk at the same time for a very small cost of covering that insurance for doing so.
Well, absolutely. The mark-to-margin threat is totally out.
Not just that. Mark-to-margin is a big issue which is out. On top of that, if I buy a futures, I'm fixing the price at that future date, and if the price goes up further, I've lost that opportunity. But the option provides me an opportunity to do that, so that's very interesting.
Gautam, getting in your first comments as well. I mean, you were telling me earlier on how almost all of your business is hedged, but in the global markets. Now, with the Indian markets throwing out so much opportunities, what is your sense? How ready and prepared are you to start hedging all of that here?
Absolutely, yes. As a refiner, we are looking at locking in our margins. So we are hedging our exposures traditionally in the international markets. But now with options being available here, it gives us an opportunity to again play on the lock in on the upside rather, as Sanjeev ji said, instead of just doing it on the futures and limiting our price. So we're really looking forward to not only gold, but probably silver as well in the coming future.
Well, yes, you have a wider range there. But Ashish, coming to you now, we've spoken to a producer, a refiner now, and from you, a retail perspective, how would you look at this new instrument come in and how excited are you to start participating?
Before getting into the option, so to say, I'll look at, last few years compared to last 20, 30 years, gold has been moving around quite peculiarly. For the end retail participant, it is very difficult for a retailer to manage the price fluctuations of gold. Last 30 years, price was only moving in one direction.
Correct.
So you could buy and forget about it. Next year, the price would be about 15% or 20% higher. But last 2-3 years has seen wild fluctuations, sudden steep drops that makes life of a retailer very difficult. And then hedging becomes even more important to protect your capital. Because at the start of the year, putting a price to your inventory, and God only knows what happens in the next 12 months and what it will end up at. So hedging is more important. And currently people are using, futures as the only hedging, but it is, not without its risks. So I think options is a much better
instrument to begin with, of course. So Shivanshu, the first comments, of course, from across the bullion industry are very, very favorable. What do you think? How are you really pitching it? What has been the feedback as you are doing your daily meetings with jewelers and the bullion industry as a whole? How aware are people, especially when it comes to options? Because many of the technology issues or perhaps the awareness on how to trade, how to still make money out of that is something that people still need to know.
Right. So essentially, first question, you see, it is about protecting the downside risk while still remaining participative in the upside, in essence. And this, in a way, becomes a non-traditional way to look at one's inventories. It is, in a sense, monetizing your inventories, whether it's through a costless collar or through downside protection by buying puts. So what we do on our part is that we are conducting a lot of awareness programs, and this financial year to date, we have touched about 6,000 entities from the physical bullion and jewelry industry via 36 such programs. And we intend to do this continuously to create more awareness.
Sanjeev, historically, of course, producers and investors, as we've been talking about, have been trading in the global markets. But with this coming into India, what is your sense on the benefits that are there? As Gautam also mentioned, that this is, going to be an opportunity, which is, of course, cost-effective to start with. There is no mark-to-market here. There is more flexibility in sense of entry and exit, and your downside risk is totally managed or protected.
Correct. You're absolutely right. The traditional jeweler treated his working capital lying in his stores across the country as his personal asset, which he required over generations at times. So the cost of that was taken as nil, and as and when he sold a piece of jewelry or whatever jewelry during the day or the week, he would hedge his net sale position by buying more gold. So that was a typical way of doing it. Now, with the need of number of stores going up, with the need to increase the inventory, and especially when a number of retailers are increasing their distribution and retail reach, this traditional method does not work any longer, because he's got additional working capital stocks lying which has been bought at a new price, at today's price, so he cannot do a cost average benefit. It does not accrue to him. In that context, what was he doing today? He was taking in a futures contract to cover his price risk. But when he takes a futures contract, he's concerned about the fact that he doesn't get that upside if the gold price goes up further. He's protected himself, but he doesn't get the upside. And that's where the options comes in. He can also get the upside as in when he takes an option rather than taking a very stale futures product. From a interesting customer proposition side, for example, you can run a scheme where you ask customers to prepone their purchase and give him or her the benefit of a lowest price between today's price and maybe the price at Dhanteras 1 week, 2 weeks down the line. So she's getting the best of both worlds, today's price versus the future price, and the retailer is incurring a very nominal cost of taking that option contract for that risk. And such other interesting products can easily evolve at zero cost also, which sounds very interesting.
So Shivanshu, of course, there's just better price discovery here, better hedging, and it's not just the producers, but a retailer and an investor, of course, would be looking to make money with the call that they would take in sense of direction on where the gold prices are headed. So how about you start telling us on what the margins are going to be? What is the specification of these contracts? What are you expecting to launches in sense of participation as you begin as early as perhaps mid-October?
Yes, so essentially these are going to be options on gold futures, which is on the benchmark 1 kg contract, and they're European-style options. And the beauty of it, like about the M2M, the advantages of not being there, M2M and all those things are there. In terms of the writing side, the margin itself takes care of both the volatility as well as the M2M. And the beauty of it is that it devolves back into a futures position on the third last working day before the start of the tender and delivery period. So post that, there is time for one to decide whether to give or take delivery or to square off the position. And on the time period before the devolvement, the beauty of it is it becomes a low-cost sort of an intraday trading option as well for the jobbers and the arbitrageurs and the financial intermediaries. You know, when you look at the bullion contracts, there is a history of being a high-value contract in the futures. The incidence of taxation has also been in accordance. So with the option coming in, any option which has a delta of close to 1 behaves pretty much like the futures in terms of intraday. So it has the excitement from the financial intermediaries equally.
Well, yes, and the lower cost and, of course, the one-time payment of fees is something that, of course, is a big benefit here. Ashish, just coming back to you onto that one, when you know, a lot of people, I mean, of course, as they said, the listed companies go in for a full hedge because that is one of their bylaws, or that's how they work. But a lot of retailers do not do that. A lot of small jewelers, the bullion traders, importers, exporters, it's not that they hedge all the time. But do you think with the options coming in it and with the kind of flexibility and the low cost of dealing into this, would you say that this participation is going to grow here?
Absolutely. The current market situation is there are, at least in last few years, there have been little options for hedging. The only option was the futures market. And it's a double-edged sword. And most of the retail jewelers are worried about the downside. Supposing they take a short position and if the price rises, then the mark-to-market pressure starts coming in. And one thing that people don't realize, when the price goes up, the retail sales go down. So it's a double whammy for the retailer. The sales go down and your margin requirements keep going up, and that's when a lot of people default. But options is a product by which your downside, as all of them have said, is limited. And at the start, you know how much you are going to put in. And that gives a lot of comfort to the retailer that, yes, I'm hedged 100%, and this is the specific cost that I will incur in the worst case. And that gives a lot of comfort. So I think hedging, even in smaller retailers, mid-size or even large national retailers, will obviously go up.
All right, just hold that thought. We'll take a very quick break at this time. Well, we have established, or our guests have established, that there are lots of benefits, of course, to the gold options here. We'll take a short break on that note. When we come back, we'll, of course, talk about on how the SEBI, of course, has been opening up this market. What are your chances of actually trading into options and making money as well?